Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. I'm going to talk about some energy type related stuff in this one. Go into um, kind of energy input costs, some oil stuff, ESG, that arena. I usually talk about this stuff because that's what I usually research. I like looking at energy because energy is the foundation of everything. It's the basis of us able to do work. Energy is more or less our food supply. We've got, food, if you think of it, is just extracting minerals out of the ground into products and us consuming those products, um, which is more or less, I guess, a mining type ordeal. And when energy prices go up, everything goes up. It's one of the most used commodities of anything. Just energy in general. I won't. Maybe you won't call it a commodity, but it's just energy in general. So let's dive in here into some of these. I'll give you my opinion, and the opinions of what these authors have written. So I've got in the upper left here, it says high energy costs are pushing zinc smelters to the brink. European zinc smelters are struggling as electricity prices continue to rise. High energy costs in Europe stem partly from high energy prices that began in 2021 due to low gas storage volumes within Europe following a cold winter. The availability of renewable power for zinc smelting and production at present is limited and at present is not an option. So zinc smelters are really struggling as electricity is a bigger proportion of the cost compared with copper or nickel smelters. This has led to rising zinc prices. So one thing I want to touch on is as energy prices increase, especially to astronomical levels that Europe has seen in natural gas and electricity, you're going to see all these effects. There's going to be first order effects, second order effects, third order effects, tertiary effects way down there, and they kind of blow out. And it can be felt and ripple across the entire economy. And things that I can't even think of off the top of my head could potentially have problems. One of the surest way bets in an energy type environment that is a crisis is to buy the outright commodities themselves. Invest in uranium directly, in oil directly, in platinum directly, because you're not subject to rising input costs that you would be with a lot of, say, these companies like this right here that are actually pushing zinc smelters to the brink. I know fertilizer companies in Europe, some of them, if they make it from natural gas, were struggling. So there's a lot of companies that are struggling. Even the utility companies are struggling if they didn't hedge their input costs. So governments were holding the end electricity cost. They're saying you can't rise it above this point, and it just squeezed all the utilities until they went bankrupt. So there's a lot of unforeseen problems as energy prices increase with some of the users or the ones that sell it. Some of the problems there. So be careful on how you choose your investments. I'm a big physical precious metals guy, and I think that high energy costs will push physical metals higher. I've thought about this stuff for a really long time, all the way back in my early 20s, early to late 20s, when I was trying to figure this all out. And for some reason, when I circle around, you can go to two paths. You can say, we're going to go this really cheap energy route. Let's say renewables are successful. They still are going to consume copious amounts of the materials that are needed for what I'm doing, like platinum and silver, depending if we go in a hydrogen economy, depending on how this rolls out. So I'm a big proponent of physical silver. And if energy prices go to the moon, well, the cost curves of all those to produce are going to go up in return, also increasing the cost of renewables. So looking at ESG, I just thought this was kind of funny. It says, are ESG funds actually popular? Like the question. ESG funds have seen a tremendous rise in popularity over the past several years. Fidelity Investments, one of the world's largest investment fund managers, just this month launched not one, but 3 ESG mutual funds and 1 exchange-traded fund. Not all ESG funds are actually attracting a lot of investor attention, however. And I just wanted to put that in there because I thought it was kind of funny seeing that. I'm indifferent to ESG. I think it's just, in my opinion, it's kind of this made up thing, environmental social governance. And one of the things that I found that people they look at cars like cars pollute. Um, in actuality, if you look back in history, cars were one of the inventions. There was one of two inventions, plumbing and cars, that raised the lifespan, the average lifespan of everyone up like 20 years. Back then, when people were using horses, we were dying of bacterial diseases. And when cars were implemented and horses were all out of the streets and they weren't pooping everywhere and we weren't walking in the poop, bringing the poop in the house, et cetera, et cetera, we stopped dying of bacterial diseases and the average lifespan went up quite a bit. So the two was basically getting bacteria away from us. Plumbing, which was the human portion of it, and then two was cars with the horse portion of it. So those are the two inventions that increased the lifespan of humans the most. So you could look at all of these breakthroughs in technology for surgeries and stuff like that. But going back to the basics, engineers are actually the ones engineering longer lives with basic solutions like getting bacteria away from you. Looking at two more energy companies go under as crisis worsens, and this ties with the energy crisis. It says two more European power companies have ceased trading due to Europe's worsening energy crisis. Under the regulator's safety net, customers' energy supply will continue, and funds that domestic customers have paid into their accounts will be protected. And I like the name of this company, Whoop Energy. Whoop, there it is, exactly. Whoop, there it is, Energy, and XCEL Power have ceased trading, affecting around 550 customers. Consumers from both energy firms will be designated a new supplier by market regulator Ofcom through its supplier of last resort process. So Whoop Energy and XCEL Power is a gas-only service. Both of them, gas and electricity, went out of business. So when you're investing, be careful who you're investing with. Make sure if you're in utility companies that they've got their stuff hedged out. So if rising input costs go up, that they have hedges in place somehow, derivative market or whatever, to protect themselves, and they should be locking in a certain profit margin. Look at this. I thought this one was a really interesting article. It says, not even $200 oil will make shale giants drill aggressively. It says, as oil prices have risen, observers that expected to see U.S. shale growth explode have been bitterly disappointed. According to executives at some of the biggest public shale firms, oil prices could rise to $200, and they still wouldn't be interested in changing strategies. Ultimately, those companies that do aggressively increase their production will significantly reduce their inventory in the long term. Whether it's 150, 200, or 100 oil, we're not going to change our growth plans, Pioneer Natural Resources Chief Executive Scott Sheffield says, if the president wants us to grow, I just don't think the industry can grow anyway. Says, in regards to the industry, it's been interesting watching some of the announcements so far. The public independents are staying in line. I'm confident they will continue to stay in line, Sheffield said. The private independents, those that have announced growth rates in the 15 to 25% per year range, are unlikely to be able to continue to grow at those rates. They will significantly reduce their inventory fairly quickly. So to me, if I'm reading this, I'm reading peak oil. He's basically saying we can't increase production. Irrespective of price, all you're going to do is increase the downside of the curve on the backside. You may bump it up a little bit, but you're just going to increase the depletion rates on the backside. So the way that I view some of this is physical metals. Physical metals and oil investments directly in those small caps that can hold production quite steady for a long period of time. We've seen a large barrier to entry with oil companies because of the ESG movement. The ESG movement, environmental social governance, it seems like they're not putting investments towards fossil fuels. So there's a barrier to entry for some of these new companies. There's not nearly as many new companies in the oil space. And I think oil is going to be a great investment because of that barrier to entry, because people don't want it. And we are still using it in copious amounts And in third world countries, depending where you're looking at, they're in the middle of their S curves in terms of their energy consumption. And I think the majority of their energy consumption will be tied to oil. It will be tied to a whole bunch of energy, electricity as well. So I think oil is going to be a good bet for at least the next 10 years, in my opinion. And then looking at this, I put this one in there. The U.S. will be a net oil importer in 2022, which is tied to this comment about peak oil in terms of oil shale. So yeah, the U.S. will be a net importer in 2022. And I think that's all I had in this one for the updates here. So again, be careful where you're putting investments. In the back of your mind, you should be thinking, is this company subject to high energy? If they were to go into a high energy cost environment, how would they do? Obviously, oil companies should do pretty well. Energy service companies should do pretty well. Uranium and other energy type companies should do very well. Renewables, I'm on the fence. They say they cost so little to produce, but wait until the commodities either have supply chain shortages, have outright shortages where they can't mine enough for it, or all of their input costs go dramatically higher, making the renewables less cost competitive. It's going to be an interesting next 10 years, I think, with inflation coming into the system from the real estate market. I'm guessing 5 to 10 years left in it. I think we're going to see a big third leg happen. So Elliott wave, you get a first leg, then a third leg, and then a fifth wave. So I think a third wave will be coming with some of these companies. Especially, I think uranium is going to have a big one. So oil, natural gas, uranium, I think those are all very three. Royalty companies intrigue me quite a bit in copper and the precious metals because they don't have the input costs. They just have volume and price. And if we go into a very large bull market in precious metals, I want the least risk way to play it, which is a diversified royalty streams across a whole bunch of different areas, which I think is low risk, and you get the leverage to the price move through the royalties and the price increase. So that's the way that I'm playing it with the majority of it in terms of metals, our royalty companies, and then all the energy companies. I also play with fertilizer companies as well because I think food prices are going far higher, far higher. If you guys like the content, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.